Hello, everyone. It's great to meet you again for the next edition of GameCamp webinar. A reminder, like at every session, we are focusing on one specific topic around mobile gaming and apps, but rather mobile gaming. Once you're listening to that, one small ask, please check in at first at campus.co/Warsaw check-in. And today we will be talking about very interesting topic that I'm very excited about. So today we will be talking about getting investment for mobile gaming company and gaming project. So today we have a lot of amazing speakers around the topic. So let me allow me to invite to the stage our first speaker, who is Jonathan Bellamy, who is Senior Director of Corporate Strategy and Advisor to CEO from Huuuge Games. Welcome, Jonathan.
Hi, Mariusz. Thanks for having me. Do you want me to jump straight in?
Yes, if you could say a few words about yourself.
Sure. I'm British, so this doesn't come naturally. So I'm one of the lucky few that started my career in the games industry and never left. I'll give you more of a background on kind of things I've worked on when I start my presentation. But at Huuuge Games, I work on mergers and acquisitions opportunities, on closing deals for the company. Before this, I worked in early stage VC. So I have quite a lot of experience doing deals in the games industry at all kinds of different stages of a company's life.
Great. Let's invite our second speaker, who is Eitan Reisel, who is founder of V-Games.
Hi, Mariusz. Yeah, go ahead. Sorry.
If you could say a few words about yourself.
Sure. So first, thanks for inviting me. You know that I'm a big fan of CEE. And I'm also a big fan of Huuuge, so we're already starting on a positive side here. I'm Eitan, as Mariusz said. I'm the founder of V-Games. I was actually on the other side. I worked for Google for many years, left 2 years ago, started as an angel investor, and now I'll talk about V-Games in my session, but we're an early stage fund investing in game companies in Israel and globally, and with a very sweet spot for Central Eastern Europe, which we'll cover through my presentation.
Great, and let's invite our third speaker, which is Rafael Pujyatsev, who is head of mobile games and apps at Google in Poland.
Hey, hello. First of all, thank you for joining this session. We are very happy that you have found time to spend this afternoon with us. I've been with Google for the last 9 years. My job is to work with a team that is supporting mobile gaming studios to grow with Google. So I'm extremely privileged to work on that subject and also to be here today with you. And our role with Mariusz will be to help you guys today to get through with the questions to our presenters. So I am strongly encouraging you to ask questions through Slido. This is the slide. Just use the hashtag GameCamp, and then please ask your questions, and then also vote for the questions that are important to you, and then we will make sure to ask them to our presenters. So we'll see you around.
Yes, so we are encouraging you to ask questions during the session and after the session. So if you could go to the www.sli.do and then add the GameCamp, then feel free to add the questions again during the session and after the session. So just again go to the Slido and then add the GameCamp as the part of the questions. Okay, so let's not make it longer. Let's invite our first speaker, Jonathan Bellamy, who will be talking about dark side of valuation, how investors evaluate your gaming business. So Jonathan, the stage is yours.
Perfect, thanks. Let me see if I can share my screen for you. Just one moment. Okay, hopefully you see what I see. Perfect. So as you just heard, my sort of presentation today is about the dark art of valuation. The reason it's not called the dark science of valuation, but I wanted to briefly cover how different types of investors will be looking at your companies and how to prime yourself ready for those kind of conversations when they appear. So I'll lead with 3 takeaways, 3 disclaimers, and an introduction. What I hope to leave you with is threefold. The first is an overview of the most common kind of industry investor types, especially within gaming. Secondly is an understanding of how these investors will value your business, or at least an overview of that. And then finally, 7 tips and tricks for maximizing your appeal to investors. That's my clickbait title. So if you'll allow me 1 minute to quickly introduce myself in a bit more depth. Like I said, I started in the industry. That was with a games company called Jagex. Worked on the sale of the company to a Chinese mining company of all people, and then its subsequent listing on the Shanghai Stock Exchange. After that, I joined the dark side, spent a couple of years at LVP, which is an early stage games industry venture capital firm. Worked on a few different transactions there, investing at the kind of pre-seed and seed level. So we've gone all the way from one end to the other end of the deal making process. And then early last year, I joined Huuuge Games after 2 bottles of wine and a night in an Airbnb with the founder of Huuuge in Kensington. I was sold. And so since then, I've worked on 2 acquisitions from earlier this year and also the contemplated IPO as suggested by our publishing of a prospectus a few weeks ago. So I'll start with 3 quick disclaimers. Number 1 is actually an apology. I'm British. So if a point can be made in 3 words, I'll probably take 12. I'm legally obligated to do so, and I apologize ahead of time. Secondly, there will be a lot of large generalizations as part of this presentation. Valuation is a deep, complex, fluffy, and quite subjective art. And we have 19 minutes. And then lastly here, I've tried really hard to stay away from the math. Unfortunately, valuation is a numbers game. And I promise you, if there is any math, it's like only a tiny bit. So allow me to introduce the cast of the show today, the 4 most kind of popular investor types for the games industry. We'll begin with the early stage VC, and recognizing that Eitan is on the call, I'll be as friendly as I possibly can. So early stage VCs buy risk effectively. They invest at the very earliest stages of a company's life. It's usually the first check that a company receives. And they focus on the quality of the founding team first and foremost, as well as the size of the kind of market they're attacking. The reason they focus on what they do is just because these companies are very young and typically there hasn't been enough history or data to really evaluate anything else. They tend to make many very small bets of between, say, $50K and $10 million at the early stage, in the knowledge that 1 or 2 of their portfolio companies will deliver the entire returns of a 20 or 30 portfolio fund. It's a power law distribution. You may have heard that said. Generally speaking, early stage VCs, or at least the good ones, will be able to offer you really strong introductions to a broad network of people that are quite senior and high value. And they also open up a really strong follow-on fundraising opportunity. If a good fund invests, usually it brings other funds with it. So these are kind of this is the stat makeup, I think, of the early stage VC. Lots and lots of risk, quite a long time horizon, 10 to 13 years usually for an investment fund, and lots of focus on the team. Next, we have the late stage investor, kind of growth capital or early private equity, you might have heard this called. They buy performance, but they also buy control in the case of private equity firms. They're still quite team focused, but they take a very quantitative approach to evaluating the business. They make multiple fairly large bets, anywhere from, say, $5 to $10 million, all the way up to $500 million plus for the larger growth investors. And they look for quite a clear path to exit. Their job is to buy, improve, and then sell. That's the business model. They offer access to very vetted leadership, usually at the growth stages, a company starting to generate enough cash to justify high-profile hires, and they're very good at making that happen. The late-stage investor is a bit more rounded, still has quite a high risk appetite and quite a long time horizon, but writes much bigger checks takes, relatively speaking, a larger ownership stake, and again, is quite focused on team, but will start digging into the numbers. Thirdly, we have the strategic acquirer. They tend to be tall, blonde, British, and very effortlessly charming. They buy performance and synergies, if I can be so bold. They conduct the most rigorous, in-depth evaluation of their business. Ultimately, they have the most to gain, but also the most to lose. And so they will dig through every fine detail. They'll typically look to acquire businesses for a mixture of cash and their own company stock. So they'll pay a little bit up front or a lot up front, and then the rest might be locked behind performance, also known as an earnout. These acquirers will seek synergies and overlaps that could be consolidated between the two companies, but also economies of scale, diversification. And these kind of strategic benefits that they can look for mean that strategic acquirers quite often can pay more for a company than a financial investor could. This is your kind of strategic acquirer at a glance. Very long time horizons. These marriages are ideally forever. Very high ownership stakes, effectively all of the company. A big focus on both the team and the product because both are joining the business. And ultimately, the largest check size a company will probably receive. And then lastly, I've thrown the publisher in here as well. Funnily enough, they also happen to be tall, blonde, and effortlessly charming, but they buy potential. They typically don't take an equity stake in any company. They take a revenue share. They focused almost exclusively on the product. The team, of course, is very important to make sure that they're focused on building the best product they can, but really they're partnering for revenue streams from a specific product. They offer marketing and data capabilities, or at least the best ones do. And then in terms of their profile, they're very, very, very product focused. They have quite a long time horizon as well. Think of it 2 to 10 years. They can write large checks if the game's sufficiently developed when they already start publishing. And they take no ownership stake, as I said. As you can see from this kind of brief summary, there really are investment options for every stage of a games company's life cycle, from the very early stage with the early VC or the angel investor, all the way to strategic acquirers, growth capital, and publishers at the other end of the scale. So the games industry has really built out this strong ecosystem of financing and investment that I think we know today. So now to dig into some of the meat of this presentation, I want to talk for a minute about the evaluation and valuation methodologies used by these different investors, because each is quite different. So this is the 40,000-foot view, okay? The earlier the investment stage, generally speaking, the more qualitative the evaluation process, less numerical. More risk lies with the team than with existing product and financial KPIs, simply because there are no existing financial or product KPIs at the very early stage. Later stage of investors and acquirers will conduct much heavier evaluation processes, and generally they will look for more details because longer lifetimes mean more baggage and more data. So the way that the early stage VC will, generally speaking, analyze a company, I'll let Eitan talk more about this, he's the expert in the room, but they will look at the team first and foremost. Is it high caliber? Does it have existing relationships? Have the people within that team worked together previously, gone through hard times and positive times? Do they have complementary skills, or is it just 3 software developers with no business guy? They'll also look at the market. So is there sufficient capacity in that market for a monster to exist? And also, is there sufficient growth to justify really high valuation multiples? We'll talk about those in a moment. And then finally, is it fragmented enough for the company to compete, or is it consolidated enough to be disrupted? Lastly, the macro environment. They will look at to understand if the space is going to be increasingly relevant. For example, if your game is very social, it's very likely that in coming years, social games will be more relevant than ever before. And is it the likely beneficiary of parallel growth? So you can think of this like if you have a very computationally heavy game or a very detailed, deep, graphically impressive game, what does 5G mean for your mobile distribution? And that's the kind of macro trend you can attribute to these startups. The way that they value companies generally is they'll look at market rate dilution, and you can think of that roughly as 20-25% at the early stage, and then look at the kind of cash required to get you to the next milestone, raising your next round, which is usually 12 to 18 months. By dividing the two, you get to an effective valuation, right? So if 20% divided by $1 million is the money that you need, and 20% is the market rate for the dilution that you'll take, you can divide the two to get to the pre and post money respectively valuations. So looking now at the late stage investor, again, they're super keen to understand the team. They're very, they base their decisions largely on the competency on management. They look again for high caliber people, but they also look for people who are experienced at a slightly later stage now. The company's growing into becoming something a bit more mature. And so the same skills required to get a startup off the ground aren't always the same skills to scale a company. Also, senior leadership, like I said, they can often bring in very vetted senior leadership. So they'll check the kind of capability of the founding team. They also look deeply at metrics. They have financial KPIs and product KPIs to dig through, especially in the games industry. You'll find that late stage investors really want to understand the unit economics of your games. And there's this rule of 60, sometimes the rule of 40 that gets thrown around. And the idea is that if you add the margin, the profitability of your company, to the growth rate year on year of your company, if they sum to 60% or higher, that's kind of a very eligible investment candidate. And then lastly here, they will look at the exit, and that's the third kind of pillar of evaluation. Are there strategic exit options? Do financial investors like these kind of companies? Is there a broad appeal of your company? If you're a streaming tech company, are you going to sell to Google? Well, yes, you absolutely could. Are you going to sell to Amazon, to Microsoft? Well, now we know they're all interested. That's kind of an interesting proposition for late stage. And then what's the exit time horizon? Late stage investors will hold companies for 4 to 8 years, generally speaking. And so that's sometimes up to 10. And that's kind of the view that they'll take. In terms of their approach, they will also do the kind of runway needs divided by expected dilution, but they'll start to build in more quantitative approaches. So this is the math I was talking about. Firstly, they'll look at the expected profitability or the cash flow generated by that company in the future. So for all the future years, and everybody I think understands that $1 tomorrow is worth less than $1 today. And so there is a discount that gets applied to each of those future years. And by summing up all of that kind of future cash flow in today's money, that's a way of thinking about the potential value of the company. Additionally, we use these multiples when evaluating companies. So we'll look at the Ebitda multiples that public companies are trading at. So the valuation is 20 million, the Ebitda is 1 million, that's a 20x Ebitda multiple. They'll also look at valuation to revenue or valuation to bookings. And so we can get a sense check by looking at all of the cash flows and then looking at the range of multiples, seeing if there's a strong overlap, you can get an indication of what the company might be worth. So we also have the strategic acquirer. They will look at the team first and foremost. Are they high caliber? Secondly, are they a cultural fit? These marriages are very long term when two companies merge. You need to be sure that these people are going to be able to work with each other for a long time. Are they aligned around the transaction? Does everybody want this to happen? And they'll start looking at metrics, again, everything in this case, financials, product KPIs, the history, the forecasts and projections, everything will be gone through and evaluated. And then lastly, they'll look for synergies. And these are places where the companies might be able to come together and remove some duplicated departments or benefit from economies of scale or diversified revenue streams. And so they also will take this quantitative approach to looking at cash flows and looking at multiples. But this time they can build a model where they say, well, yes, they are expecting $2 million of costs per year of OPEX. But actually, if they joined our company, that might actually only be one. And you can see very quickly how that becomes quite valuable to a strategic acquirer. And then lastly here, we have the publisher. And they don't really value the company because they're only looking at products, right? But they do look at the continued development of the product. And so the team has to be really focused on making that published product as good as it can be, willing to cooperate. Secondly, it's all about product metrics. So CPPI, eCPI, organics rate, K-factor, retention, conversion, ARPPU, ad revenue, everything, right? And the idea is that you can pull all of these KPIs together to effectively look at the cost of acquisition against the LTV of a product. It's that simple. And so that is the kind of fundamental golden ratio. The way that they do that is they look at that golden ratio, make sure that there is a positive ratio there, and then they'll start KPI benchmarking against other games in the category. They'll start then taking those KPIs and building product forecasts and turning those product forecasts into financial forecasts. Once you have a financial forecast, you can then start thinking about revenue share market rates and developer stipends or minimum guarantees. And the idea is that a publisher will look at the expected value of all those future cash flows from that product, how much they're paying as a rev share, and suddenly there is a value intrinsic to that publishing deal. Okay, so just before I wrap up, sorry.
John, just to interrupt you for a second.
Sure.
First, we have some questions already. So if that would be okay for you to just stop here for a minute and ask a question and then move on, that would be fantastic. So, and one more technical kind of favor to ask. If you could just please reshare your screen, because we just see it as a very small window. If you could just stop sharing and start sharing again, that would, now it's going to be awesome. First of all, thank you.
Okay, now you can see my presentation. Let me start from slide 1.
Much better.
Okay,
so
good.
It was previously a much smaller window. Okay, so the question is, what kind of VCs should the gaming studio that needs funds be approaching? The ones that are specialized in gaming, and you know that they have a path, a history of successful cooperation with gaming industry, or also the ones that will be a new kind of field for them? So that's the question. And I also encourage everyone on the stream to use Slido to ask more questions. So thank you.
Sure, no, good question. So firstly, they should approach my friend Eitan, who's on this this conference call. He's the first stop. After that, you need to recognize, I think, that not many games companies have the luxury of having so much interest from only one type of investor that they can afford to focus on just a couple. And so it's always a good idea to approach any investors that you've seen that have activity within the gaming space. Very easy ways to find that information. And then treat them as kind of A tier, B tier, C tier investors, with the C tiers being maybe those who don't normally play in the game space. And just recognize that you're going to have to tailor your pitch when you are presenting your company based on the kind of sophistication or education in the gaming space that the investor has. So for somebody like Eitan, you can pitch him the 5-minute version of your company. He probably fully understands it by minute 3. Whereas for the university endowment fund, maybe not, right? So it's about being flexible, I think.
Okay, first of all, okay, thank you. So we're ready to get back to the presentation. Thank you for the answer.
No problem at all. So I want to leave you today with my sort of fundraising cheat sheet here. So there's a few tips that I've put together that I think will be helpful. Some of them are very cliche, very old, so forgive me if you've heard it. Others maybe less so. So firstly, this is the oldest one in the book. This is get a warm intro, and everybody's heard it, but it's as true today as ever before. I think in this world of connectivity, it's become so easy to just send a PowerPoint presentation or a PDF and a blind email to an investor. I'm sure Eitan understands what I'm saying when I say that, you know, we receive hundreds or thousands of those in a week if it's very busy. And actually, it's not only very difficult to go through that many, but it's also very easy to get lost in the sea of not very good pitches. So find somebody that you know has a connection with the investor you want to reach. Ask for the warm introduction. If they're willing to give it, take it, and then come into that with the knowledge of that investor's existing portfolio and what they've done. So come in there with a reason to be trusted. I think the second one is don't be fluffy. And I recognize the irony, having used 400 words on the last slide, but clearly communicate the problem that you're solving and the opportunity at hand. You should be able to do this in 30 seconds, but also in 5 minutes and also in 60 minutes if you're sitting in a dinner with somebody. Have simple, clear, and beautiful materials. It sounds superficial, but 1,000 items on a slide make it very hard to take away your key message. And if you're 3 days into starting your company, you probably don't have thousands of slides worth of information worth sharing anyway. Secondly, have a large market. And if you don't have a large market, show why it's going to be a large market. Like I said, these investors, they target power law returns, right? They need to know that one of these companies is going to be enormous, probably a unicorn. And if it is, it needs a market that can hold that kind of size company. Show your target market that it's big enough, and also that it's growing fast enough to be appealing. Fourthly here, everybody has a strong team, right? It's universal and benign to say my team's amazing, every team's amazing. What you want to be is uniquely qualified to take on the challenge that you have. If you're looking to build exceptional free-to-play hyper-casual games, you know, having 10 years at Voodoo is much more impactful than having 10 years at, say, Zynga, another great company, but not as applicable. Not only is this very compelling, it's also a repeatable soundbite. So when the associate or the principal goes to the general partner and says, you know, here's the company, they have 20 years of combined experience in social casino and they're building social casino company, it's very easy to connect the dots. Fifthly, here we have known KPIs. So know your numbers, what they were, what they used to be, what they are now, what they need to be successful, and also how they compare to your competitors, which you will be benchmarked against. Inspire faith in the investor by being objective and level-headed and knowing the information that saves them the legwork. It's a luxury for them. Know what you need, and more importantly, know what you don't know. So every founding team requires 4 things: cash, expertise, time, and a platform. Unless you're building a platform, then you just need more cash and time. How much of each you require today and at your next milestone, you should know innately. If it's going to take you 18 months to get there, to your next milestone, your Series A round, for example, and you know that it's going to take 3 to 6 months to fundraise, you should have enough cash in the bank to make that happen. Sort of penultimately here, think long term. So each of our investors has a between 5 and 15-year time horizon, and each is in the business of outsized returns. So risk management in the short term is very appealing, but realizing massive potential in the long term is the business that each of these investors is in, especially at the early stage. So think long term, speak long term, but also don't live in the future. And then finally, the secret weapon is FOMO. The fear of missing out is probably the most potent driver in any investor's world. Whether we accept it or not, it's an art, it's not a science. And I would advise that you don't try and manufacture this fear of missing out, don't fake it, but rather orchestrate it. And what I mean by that is, instead of telling investor A that investors B and C are all ready to write a check, if perhaps they're not, the best way would be to speak with investors A, B, C, D, E, and F within a short period of time, because they will chat with one another behind the scenes. And if everybody's making decisions at about the same time, you stand the best chances of building that FOMO feeling. So maybe with that, I can wrap up this this short talk and move on to any more Q&A that you guys have.
Thank you, Jonathan, for the great presentation. Maybe before moving to the next part, I will actually ask you one question around VCs, because probably you saw a lot of cooperation between VCs and different companies, and sometimes good cooperation, sometimes it wasn't. Yeah. So what kind of the biggest challenges you saw in cooperation with VCs, and maybe any advices how to avoid it?
So you mean from the company's perspective, the biggest challenges with the VC?
Yes, exactly.
Okay, so 2 things. The first is alignment. I think it's important, if you have the luxury to have the choice of investors, picking the investor that is aligned around your long-term goals and is not thinking too short-term will be massively impactful. So let's say if a venture capital firm, let's say a company receives an offer for an acquisition from somebody like me. It may be the case that a venture capital firm sees the opportunity to cash out and take their return at that point, and that is their business model. But maybe the founding team aren't ready to accept that offer. Or maybe the opposite is true. I think you need a partner in your VC that is going to see eye to eye with you and recognize that if you don't believe it's the right time to sell, or you do believe, they can trust in you to make that call. I think Eitan's probably the best guy to speak on this question, though.
Thank you very much for the answer, and of course, Jonathan is staying with us for the end of the webinar, where we have the Q&A session. I really encourage you to add the questions to the Slido. So feel free to add questions to the Slido and vote on those questions, because we'll talk about them at the end of the webinar. So thank you, Jonathan. And now let's I have the pleasure to invite our second speaker today. So let's invite to the stage Eitan Reisel, who is founder of VGames, and he will be talking today about how to get prepared for discussions with the game investors and what they actually are looking for, especially in the pre-seed and seed investments.
Thank you, Mariusz. Thank you so much. Actually, I love the fact that John was before me, because I think he covered a lot of the high-level things about investments, and now we can really double-click. So before I start, I just want to refer to one of the questions that was asked in the previous session. I think, and John really nailed it right. When you're looking for investments, first target whoever you can get investments from. We'll talk about this a lot. If you have the opportunity to take from somebody that understands your category, I think that's totally the right strategy for any category that you're investing in. Okay, now let's double down on pre-seed and seed. So as I said earlier, I'm Eitan, I'm the founder of V-Games. A little bit about my history in games. So I wasn't a gamer as a kid, but I've joined Google 2010 and then 2014. Got a really amazing opportunity to start gaming business out of Tel Aviv, working with a lot of the largest game publishers all around Europe and in the US. Really fell in love. I became a gamer. I play a decent amount of time every day, about an hour, but I'm a father of three, so maybe an hour and a half or two, depending if you call the fortnight hours of playing with my kids. I've left Google 2.5 years ago, started, as I said, doing angel investment in this space, and then started a fund, and I'll explain why in a second. So what I'd like to cover in the next 15 to 20 minutes is what are game investors looking for? Instead of using my template presentation, based on my conversation with Mariusz, I really tried to see how I can gather most of the questions that I'm asked on a frequently or daily basis, put them on the table. And then of course, if you guys have additional questions, I'm more than happy to hear. And we're gonna focus mainly on pre-seed and seed. We do invest in later stages, but it's really to double click on what John already shared. So what is this not? I'm not gonna share in the next 15 minutes how the best deck should look like or what the right template is, okay? It's really what we as investors care for. I think I'm speaking in the name of many investors because I think the early stage folks are looking pretty much for the same thing, maybe on different angles. But it's really, these are the places where if you come to us and you pitch, what are the important things that we hear? Okay, so I like to call this the triangle. The triangle meaning, how do we look? And I think John covered some of these points already. So one, team, and I'm going to double click and elaborate on each one of them. Team, of course, is the number one factor when we look into an investment. The reason is an investment is like some sort of marriage. It's going to have its ups, it's going to have its downs. You know, we have to make sure that we're on this together, we're aligned on the vision, we're aligned on the strategy. And I always call it the cup of coffee test or exam. When I pick up the phone and I call my portfolio companies, or when they pick up the phone and they call me, they would like to have a cup of coffee with me and not, we have to talk to Eitan again. So I think team, and we'll talk about the experience and what we're looking for is super important. Of course, game, genre, category. Again, we'll double click on that. And then the biggest question when you get to pre-seed and seed investments, what data should we be looking for, right? Because if it's a pre-seed investment, I don't know if everybody understands, a pre-seed investment is usually a team and a presentation. Seed investment is usually a team and presentation and a little bit of progress. So there's not a lot of data to show. And I'm sure there's a big topic around what, if I don't have any data, can I approach investors? How can I approach investors, etc. Okay, so let's start before anything else of what we're looking for. A good pitch or a good story when you approach an investor, and I agree with John, it's better off be from some sort of colleague or referred to us and not just only a cold email, because at the end of the day, I get in general around 4 leads a day. So we want to make sure that, we have, and when we get from people that we respect and good connections, of course it will get more attention if we like it or not. But when you're coming to us, the first thing is, remember, we have to hear a good story. We hear many stories. And when we hear a good story, something that we relate with, something that we feel connected to, we'll of course want to deep dive and understand more or learn further. On this front, the only thing I'd like to say as a tip is try to learn or do some due diligence on who you're talking to before you approach them. Because I think, if you see our webinars and news and PRs, etc., if you see how we think about things, I think you can tailor the story better to what we're looking for. And the second thing, and probably maybe this is one of the most important topics that you encounter as a pre-seed and seed investor. Not every investment is an investment opportunity for us. And some of the investment opportunities are much more publisher opportunities. Now, I think this by itself can be a session. If I really are looking for the 3 pillars of should I target an investor and should I target a publisher? I would look at three components. One, these are totally different strategies. If you're looking to build a company that's an independent company to self-publish your game and take it to be a big title that can generate a lot of money, and as John mentioned, generate value for you as founders and for us as investors, probably more on the investor front. If it's more a game-by-game strategy, most likely it's going to be on a publisher front. The dreams or strategies are a bit different. Where you want to be in the next 3 years, 5 years in terms of a company, cash that you'd like to meet during the way, etc. And then, of course, again, without going too much into details, is there are different games. There are games that are very, very heavy in terms of building mechanics, tech, that a lot of investment is going into the infrastructure itself. And then you do need a third party to support you. And then there are games which are more loose and easier to bring into the world. And then they're probably more investors. So it doesn't mean that we don't invest in AAA or very, very deep tech games, but still we'll have to make sure that the capital and the strategy of the company is one, not only to do one hit or what we call super indies, but to build a roadmap and really build value creation over time. Okay, now let's go back to our triangle, right? Team, game, and data. So I'd like to cover each one. First is team. And now really, this is where I'm going to emphasize most of my effort, because that's actually where the majority of due diligence is done when we do pre-seed investments. So why is this so important? First of all, as I said before, this is a relationship. We're going on for a long-term relationship, and we have to make sure that we have common grounds. We come from cultures that we understand, right? This is really on a personal angle more than anything. Second, experience. Now, I've get this question a lot. Is it important here? I even put it on the slide that I have experience in games. So I'm going to say yes, but I'm going to put a disclaimer on this. We meet many founders, or I meet many founders who come with beautiful resumes. They worked in the top gaming companies in the world. But if you ask them if they've ever launched a game into the market, many times it will be, I took the game from $100 million revenue to $120 million revenue, which is amazing. I personally did not do that, but it's still something that there's a big difference when you take a game into the world or when you take a game from a certain level to the next level. And me as an investor, I'm much more interested in taking a game into the world. So I less care for the brand. I care for the experience in the gaming world to understand what does it mean to publish a game, take it out to the world, initial metrics, improvement, etc. So yes, experience matters, but on the other hand, don't feel uncomfortable if you don't come with big brands in your resume, right? And a lot of the early stage stuff we do is young folks. A lot of the games that they built were stuff that they did as kids, and we're still very supportive. The second thing in terms of founding team, then it's very important to understand, one, how the functions are divided, and two, not only how the functions are divided, but how you as founders complete each other. So if there's one founder that's very, very strong in product, and then there's another founder that's very strong in product, who's going to take on the tech? Who's going to take on the monetization? Now, it doesn't mean that every team of founders have to have all three pillars, but it totally supports that the more knowledge we have at the founder level and the more differentiator that we have among founders will support the success of the company. And the third thing I'd say about the founding team is that if you've worked together in the past, you went through the hard days and the amazing days and the excitement and the downs, and you already have the stickiness of a team, of course it gives us more comfort as investors. But team is not only founders, of course it's also team members, because you don't also want 10 founders. And why is this so important? So the first thing that I look into is not only the founding team, but who are you as founders able to attract to your team? That says a lot about your leadership skills, right? So we're an early stage company. We don't have a lot of money to pay. We don't have a lot of ESOP to share. And even if we do, it's not valued that much because we're only starting. But if you can still get people, and one, they can compensate for the experience that you're missing, and two, they're strong in what they do, that's a very, very good sign on leadership factors, right? So if we want to see a team of founders and the team itself, We want to see a combination that this team together can take this game into the world. Now, I get a question of what is the right size of a team? It's a great question. I don't have the answer because it really depends on what game we're building, what should be, how lean should the team be to get something to the world to prove the concept before growing? Should we start with a larger team? I think the correlation between the type, the category, if you're building a AAA versus mobile casual versus a PC game, that will probably differentiate how much money or burn you should be spending, and of course, the size of the team. Okay, so with that, let's move on to the second pillar of the triangle, which is the game. So what do we care for in the game? First of all, and I think John covered a lot of these topics, and again, let's just elaborate a little bit more. So when we look into a game, remember, we're looking at a presentation. You're going to tell us that this is the next big thing, which we believe, because if you believe and you're devoting your time and effort and money into it, and of course those families, etc., when you're an entrepreneur, everybody is in this cycle, then we want, or I want, that you prove to me why this game has the potential to be so big. Why this genre, why the match or mismatch or mixture of genres is so unique or so important, right? We all understand that we're living in a very, very, very competitive scene. Gaming is booming, but when gaming is booming, that means that there are a lot of developers coming in from indies to the largest companies in the world, building beautiful titles. Why is my game different? Why are people going to play on my game? On what platforms are people going to play on my game? And if we don't have good answers for that on the pre-seed, and it should be backed by data showing competitive metrics, showing some maybe App Annie data, showing why we believe that the combination of two genres can create one big monster that does not exist, it's going to be very hard for us, even if it's an amazing team, to be convinced. Okay? As I said, competitive landscape is super important. How does marketing landscape look like? I'd like to see some benchmarks. How do we approach the marketing angle? Because if we only do paid, and we're competing against the giants, even if we invest $100 million into this company, they probably have more cash, right? What do we know that others don't? Or why do we know this that others don't? Many times this can come back to our expertise. Maybe we've worked on games that were different. We have that experience, and now we can bring that experience into new categories. And of course, and I'll touch upon this in the next slide as well, content has to be unique and has to be king, because if we're coming with something that's pretty similar, it doesn't mean that you can't create copycats that are successful, but the risk versus opportunity, the risk gets much more weight. Okay, and then maybe just to emphasize, we know that discoverability today in games is probably the most difficult part, right? So if we really want to challenge ourselves, right? Before you come to investors, you're first challenging yourselves on if you believe that you have that angle or not. If you believe, convince us why you believe that should be, the right mark for saying, okay, it's not only that we're a very strong team, but we believe that we have a strong game, although it's still on a deck and not live. Rafael, you want to?
May I please jump in with a question, or actually two? Going back to your previous slide about
Sure.
A unique genre and competitive situation on the market of a given idea of a game. We have a question on Slido. So there's one for you. How important is the genre in the whole investment that you are considering? And then the second one, a follow-up question. Do you have some genres that you prefer when making a decision?
Yeah, so I think it's a great question. So the first one, so let's take an example. A company can come and say, I want to build the next Homescapes, right? Homescapes is, for those who don't know, is the company where the publisher is Playrix, right? They're a very big company. They spend a lot of money on marketing unbelievable titles. I'm addicted to Homescapes. I actually told that to the founders not long ago. If you're building another Homescapes and you don't have a very strong angle to be the next Homescapes, how are we going to compete with them? What are we unique in marketing? We're unique in content. Maybe we are using a strong IP, but for me, genre is at the end of the day how we come into a world with, or it's untapped, which is hard today because we're very, very crowded. And two, even if we come to a world that's relatively crowded, what's the new angle that we're bringing into that genre, okay? And then on the second question, I'd say so I'd like to say that we would invest in anything. There are categories where it's going to be very hard to convince me that there's still room. I'll give you one example. I think hyper casual today is very, very, very crowded on the top level. So it may be interesting for indies, for me as an investor, to take and build the next Voodoo. I think that's super, super difficult, especially with IDFA coming along, et cetera, et cetera. And if we go on the other front, right, we have John here from Huuuge Games and Social Casino, right, that we have very, very big players, very, very defensive in terms of marketing, et cetera, right? So I'd like to say that I would look on anything, right? Besides gambling, I'd look at anything, just so that we don't invest in gambling. It's nothing personal here, but again, we have to be convinced that there's still room for new categories. And we have 7 portfolio companies in the fund. We're only 6 months year old, so I believe that there are still a lot of opportunities in the market. Don't get me wrong; I'm not trying to give the dark side of here, although the presentation is in black. But but it's really and maybe just to cover that point, I think the most important thing is the founders have to convince themselves. Forget about us. Investors are not important. They're the ones that devoting. I have a portfolio. I'm going to put some money here, some money there. Of course, I love everybody and will invest time. But they have to believe that there's space for what they're building. Otherwise, they're going to waste now 2 years, 3 years, right, on exactly that. So if they convinced, they should be convincing me. If they're not convinced, then there's a different issue.
All right. Thank you very much.
Okay, perfect. So we're almost there. Okay, and last is data. I think this is probably the most difficult one, but I'll try to be as humble and as possible. Okay, so do I need data? Right? Isn't the idea enough? But we are a strong team. Okay, so folks, I'm going to be very, very transparent here. Raising a pre-seed and seed rounds are not easy. They're not easy because if the investor doesn't know you personally or has personal connections, he's really betting on the due diligence that he does, especially in the world that we're living in now, that I'm making decisions through, we're on Google here, so Google Hangouts or Zoom or whatever, Skype, whatever, just to cover all the tech companies. So of course it's easier when we know the teams. So to answer on a simple note, no, we can invest without data. But if on the triangle, we have a question mark about the team or a question mark about the game, I personally will want to see data. Now, we'll talk in a minute about how do we get to data without fundraising, and I think there are ways to do that. But again, just to put this in one box, because I think this is a very, very important topic, is if you tick the boxes on team and game, high chances we'll move forward. If we have question marks in one of the both, there's high chances we'll want to see data. Now, before I go into what data is important, how to do that, right? So it can be of building the first game as a work for hire. It can do it while developing at night while having a full-time job somewhere else. I know these things aren't easy. In general, entrepreneurship is not easy, but sometimes that's the leap of faith that you have to show and the initial metrics that you have to show to move on with investors. Now, if we do want to see data, I think I'm emphasizing my point here with one word just in many times. Retention for me is the #1 factor. Day 1, day 7, day 14, day 30, and that's pretty much enough before depth. The reason is because I think this shows so much about the game, right? Before anything else, before ARP, DAO, RPPU, POW, DAO, whatever. It shows that people want to play your game, and then I promise I'll help you find the monetization solutions if we have strong retention metrics. Of course, then the next layers of data will be monetization, ARP, DAO. We want to see growth curves on all the metrics, POW, DAO. But again, if we need to prioritize, if you come with strong metrics on this, to be honest, on the pre-seed and seed, I really less care of these metrics. Show me that there's a business thinking and we'll figure it out. So to summarize, team, game, data. We're not 100% sure here and here. On the pre-seed, we're probably going to emphasize and ask, yes, to see some initial metrics. Just one before we end. Why Central Eastern Europe? So I actually fell in love with this region many years ago while at Google. I think they're the most talented people in this region that are building the best games in the world. And that's why we as a fund really put on our frontier of deep diving and analyzing and building alliances to find opportunities. And I can promise you that in the next year, I don't want to say many because I don't know, but we will do at least 1 or 2 investments in the region. It can be a pre-seed investment, seed investment, or a later stage investment. So with that, please don't hesitate to contact us. The best way to contact us is just to go. I personally answer all the contact us forms on our website. It's vgames.vc. I also have a blog post there where you can read a little bit about how the way I think about the industry, etc. And please just make sure that you cover the points that we discussed. Will just make your life and my life easier. So with that, I think we're done. Thank you. Alish, are we good?
Thank you, Eitan. Thank you, Eitan, for the great presentation. So maybe just before we go to the final Q&A, maybe I will add one follow-up question to the thing you actually underline, because you talk a lot, for example, about retention as the way to show early data. Some kind of how many players do you believe is pretty good sample to show you, to make you believe, okay, that's something that I can really trust, and put some kind of idea and measurement behind.
Yes. So you're asking about the size of the sample,
yeah.
What are the okay?
Right.
So to be honest, I think it's a little bit to what I said before. I think that it's really, if the founders believe in the sample, I'll believe in the sample. If the sample is too small, the numbers don't mean a lot, right? But on the other hand, they don't have to be too big. So if I have to give a good benchmark, I think 500, 600 DAO, we don't even have to go into the thousands. Over time with a few cohorts is great. I think actually, I don't know if everybody knows, but I think the beta groups in Android are amazing. They get you to beautiful, beautiful DAO on a very, very interesting market. So maybe, I know to benchmark that and say, okay, maybe these are a little bit more involved because they want to provide feedback, etc. But still, I don't need you to spend endless amount of money on getting these users. For that, we're injecting cash into the company, right? But to get a sample that, statistically, we can say, okay, we feel comfortable with it. And of course, we have to see some cohorts, right? It can't be just one cohort and goodbye. I hope I answered your question.
Yes, thank you very much.
Perfect.
So I will just remind again, because we are going to the Q&A discussion. I will just remind again to go to the slide. If there are any questions you have. I think it would be great to have both Eitan, Jonathan, and Rafa and me actually to discuss those things.
All right, but before we will go to Slido, I have a warm-up question to you guys. So before the pandemic, we were meeting on a huge meetups, conferences, and it was a great opportunity for you as well to be networking with your potential partners. So what is your modus operandi now? Are these just, as John mentioned, those warm intros from friends of friends, or how the gaming studio could connect to you without just through a website, as Eitan said, or through warm connections? But are there any other opportunities to get to know you and get to connect with you?
So first of all, yes, it's more challenging, right? We don't. There's not a lot of beer drinking, and last time I was in Warsaw was amazing. We had this great evening, and I met a lot of folks, etc. But I think entrepreneurs, their life is difficult from day one. Part of it is finding the right investors and getting to them. But I think based on the amount of traffic, the inbound traffic that we're getting, I think folks are doing a pretty good job. We're not hiding. I try to share my thoughts, and when we go on press and stuff like that, it's not because we're building our own brands. We want people to have the door open and come in. I can give you my personal angle. I try to answer, I reply to everybody. Sometimes it takes me a little bit of time. I don't have a staff of 10 people. I try to look at every email that we get, every approach that we get in the website, read it carefully, see if there's interesting stuff for us. We don't invest in everything, right? But I think those who are looking for investors, and here I think an opportunity like this is amazing, because I think folks now hear us and they're more than welcome to approach. And I think it's warm welcomes. I think is like anything in life, right? If you have a friend and a friend of a friend says, folks, these are a good team, it helps, right? It filters a little bit more filters on the way, but it's not mandatory. I've invested in companies that were cold approaches as an angel investor, and actually in V Games as well. So.
All right. Thank you, Eitan.
Sure.
Okay.
Right.
I think we can move to some questions. Maybe starting actually from both of you. Maybe starting from John and then Eitan. Like how to actually estimate how much money I need. It's kind of should I talking to the investors? I should, especially with the pre-seed, should I ask as little as possible, or look broader? What is your opinion in this case?
Okay, I'm going to kind of cheat and say use common sense, but in terms of how much money you need, definitely plan out the next at least 12 months if you're a games company, ideally 18 months given the way that things look today, at least in my view, and think about runway for 18 months. What do you need? Are there any specific hires that you plan to make in the next 12 or 18 months? How much extra cost will they incur? So really plot out your operating costs for the next 18 months. And then also think, well, if I have something that's releasable within that time, do I want to have enough money there to be able to test the game, even at a small scale, acquire some users? And so that's another consideration. One final thing I would say is expect it to take between 3 and 6 months to raise funds. So even if you think it's going to take you 9 months to get to the point where you have a product that is so clearly scalable, you could go on and raise more financing, you should still set enough time, 3 to 6 months aside, to make sure that you have the time to raise those funds. So if you think it's going to take you 9, raise 18 months or raise 12 months just to be safe. Don't be too tight when it comes to how much you're looking to raise, but also I think it's fairly easy to see that if the average dilution is between 15 and 25%, and you're asking for $6 million at day one, that's going to put a lot of pressure on your valuation. And if you don't see many companies raising at that valuation, it's probably because it's not quite in that ballpark.
Totally. Yeah, I agree with every word. The only thing I'd add to that is that question is every question that an investor asks, we should refer to as a due diligence question, right? So when I get an answer on that question, the thinking behind how the founders answer is super important for me. Why? Because I'm now becoming the one that's funding them, and there's high chance that I'll need to fund the next round as well, right? Or participate in the next round. So the way of thinking about the capital, the way of thinking about how organizing that capital is a very, very important due diligence question when you talk to founders. And that's probably a general comment. Remember, when investors are asking questions,
and Eitan,
they want to hear the data behind it.
Eitan and Jonathan, actually maybe to add follow-up question, because right now in many cases the cost of bringing the game to the life can be for example lower than even cost of marketing, growth of specific game. In this case, are you advising just to ask for money for development and then find the other source of money for growth, or in this case, a discussion with VC, as in discussion, especially with the pre-seed and seed investment, can include this marketing and growth budget as well?
Eitan, I'll let you go first on this one. I think I've had the first word every time so far.
No worries. I think it refers to what we just said now. It has to take you to the next milestone. If it's a pre-seed, it usually won't be a $2.5–3 million check. It's not very common, right? But we want to make sure that we make enough progress that next time we raise capital, even if it's us investing, we justify the valuation in terms of progress, right? So it really depends on, it's very hard to give one answer here because it depends on the category, depends on the genre, depends on the type of game. But again, it really has to take you to the next level. If the next level is getting the game out there and testing grounds, it's not enough to raise only for the development. You have to raise also to have marketing for the initial tests. And as John said, enough marketing that can take you to a leeway that when you start the next round and you have the good metrics, you still have money, because we don't stop, right? Investments are not, you finish the money and then you go get the next. You have to make sure that they overlap for at least 3 months, the minimum, for the next round.
Yeah, I fully agree. I think that's exactly right. And that's the perfect pre-seed answer. I think if I take it just one step further on to the kind of seed level, let's say you've raised a little bit more money, you have a product that is now approaching the point where you can start scaling it. You then start thinking about raising a Series A conventionally, right? And there are two ways to do that in my experience. The first is that you raise a Series A based on how incredible the game is and how great the future looks. And that's kind of raising money based on your vision and your story. And that can be effective, but far more effective and objectively testable is having a set of KPIs cohorted from a statistically significant user base that show that, look, we're ready to scale this game. It's already good enough. And will only continue to get better. It's much easier to raise money when you're in that position and you're holding those cards. So I think I fully agree with Eitan's point.
All right, thank you. Before we will go to more generic questions, we will focus on the concrete ones. Łukasz is asking, are investors, not publishers, willing to invest in a company making hyper-casual games despite how uncertain that market is? I know, Eitan, you have covered that partially, but if you see a potential in a hyper-casual, what do you think about it?
So again, I think it really depends on what type of company. If you want to become the next Voodoo, you'll have to really prove why and how. If you're building hyper-casuals for as a third party for publishers, it's a beautiful business model. I know indies that make millions of dollars like that, less on investment strategy. So that will be my simple take on it. As an investor, I've never invested in a hyper-casual company. Not as an angel investor and VC. I don't see myself doing that, to be honest, anytime soon. So I guess that's my most concrete answer on this one.
Yeah, I agree. I think it's, Zynga did, right, recently, but they're not a conventional early stage VC. I think there's room at the kind of top end of the market for strategic acquirers. I think it can be very useful if you have very strong data and marketing capabilities to then plug those into a portfolio of hyper-casual games. Or maybe the other way around, maybe the hyper-casual companies built those expertise and you'd like to bring those in-house. I think it's really tough at the early stage.
Thank you. You mentioned that a little bit, but there were actually a few people who underlined the question, what do you view as the most important gaming trend for the next 5 years? Do you see something specific that you really believe in? And do you believe that projects looking at that have bigger potential, or it's kind of so uncertain and so fast-moving business that it's kind of hard to talk about anything that kind of comes to your mind?
Maybe John, you want to go?
Maybe
sure. Yeah. Okay. So a couple of things. You're right. It moves super quickly, but there's a couple of things that get me really excited. The first is very cliche and is said by many people, but I think games as a social network still has plenty of room to grow. I think when you look at some of Huuuge Games' core cohorts from 2016, they're actually generating more playtime and revenue today in mid-2020 than they did 2 years ago. And that is because in-game they've made friends. And when you have those social drivers that keep people coming back, you stop seeing retention on a daily basis, you start seeing it on a yearly basis. And I think that is pretty extraordinary. And we have later stage investors like Andreessen Horowitz that are pushing the idea of games as a social network very aggressively. A few people are thinking that way. The second point I would make there is maybe outside of mobile, but I do believe there is a place in the world for game streaming. Back at LVP, we had a portfolio company called Polystream that's pushing really hard to get players, spectators inside the games of streamers and other content creators. And I think there is something there that we haven't really been able to nail, but there's some potential.
Yeah, so just to add on mine, I think I actually wrote a blog post about this, which I'm happy to share with the community. I think the biggest trend, first of all, I totally agree with John. I think social is big, and I think COVID only, moved that forward a few years, right? We see a lot of people just sitting on the game and communicating, which I think is amazing because it's combining platforms. I do think that the biggest trend today, and I think it just was justified with Microsoft buying Bethesda for $7.5 billion, is that tech and people at the end of the day are playing content. They don't care that much about the platform, right? And where they're playing the game. And I think that's a category or a change in mindset that we should start exploring, right? So it used to be I'm developing for console, developing for PC, developing for mobile. You should be developing a game and allow people to play and many platforms as possible, right? And I think that is a very big shift in mindset. We see a lot of investors going that way. We see a lot of companies going that way, big companies going that way as well. And I think that's probably one of the best or biggest angles that we should look into. Marish, if it's okay, I do want to hijack one question here because I think it's super relevant for CEE.
Sure.
Is how much typical I would need to sell as a percentage of pre-seed. And I'm going to just share from my experience. I've looked at several companies, actually specifically in Poland. When I came to the table, the cap table was 60% owned by investors, which I think is amazing because, as John said at the beginning of his talk, when you can get capital, go get it. But I think, and this is a tip, which is maybe easy to give as an investor, but very, very, I would be cautious about. Investors invest in founders. They don't invest in other investors, okay? When we come, one of the things that we have to look at is a cap table. And the cap table at pre-seed and seed has to be owned by the founders because we are already going to take a nice chunk because we're taking high risk. And if they are not left with enough, we don't know that they're motivated enough. And when the next opportunity comes, they may chase it, right? So one thing I would be cautious with, don't give that much at the pre-seed. And I'm saying it as an investor. I sometimes have opportunities to take 60, 70% of the company at a pre-seed, and I won't take more than 30. The reason is because I'm going to demotivate the team over time, or when the next investor comes, I didn't leave them a lot of room to come in, right? So if you're looking for a rule of thumb, try not to cross the 30%, max 35% front on the pre-seed seed to allow yourself to be diluted later on, but still have enough of the stake to be motivated. So sorry for hijacking, but I just saw it and I didn't cover it, and I think it's a very important topic.
Yeah, it's actually very, very, very great question. And maybe do you have any advices how to do it? Because I saw that, for example, I saw situations happening like that when some founders, for example, were forced, because, for example, the money was ending and they just didn't have any kind of other option. At least they thought they didn't have any other option to kind of go that way. Do you have maybe any tips how to avoid it? Do you want?
Yes, I don't know if there's right or wrong, right? Because if you need capital and you want to move on, you need capital, right? And you're going to have to take whatever is on the table. I think there's common sense of negotiations, which is common sense. And I think it goes back also to what John said earlier. I think it's a lot in terms of planning, right? Maybe this is the important point here. Fundraising is another topic that an entrepreneur and especially a CEO have to deal with. It's not just another thing. It's like you're working on your product and you're working on your growth and you're working on your hiring, you're working on the office. You have to also work on your fundraising, right? And if you're so focused on one thing and you don't look at your balance sheet and you get to that point where you'll be able to be squeezed, you'll get squeezed, right? And if there's no time and now, you can't fly to the next conference and meet, et cetera, et cetera. So probably the best answer will be plan ahead. And yeah, of course, there's always going to be the exceptions. And sometimes it's okay. Sometimes getting a 90 or 50 or 80%, sometimes is some sort of acquisition. And then maybe people will also be secondary money. There's not right or wrong. It doesn't mean that it's not right. I can tell you that somebody that needs to follow on the round, if I come to a cap table that's too crowded with investors in early days, even if it's an amazing team, most likely I'll say no. Unless they're agreeing to regenerate the entire cap table, bring back stock to the founders, and then move on from that, right? Because otherwise, it's a matter of motivation. We're not going to take the risk if we believe that the founders are not going to be motivated enough over the next 3 to 5 years, 10 years, etc. Because there are many opportunities. It's not because we don't want to, right? I don't know if I gave you a good answer, but the most honest one I can give you.
Great, thank you. Do you have any, Jonathan, to add to this in this case?
Yeah, I mean, wearing my early stage hat, I'd have said exactly the same thing. But if I can go a little further, wearing my late stage and acquirer hat, I'd say it's equally a turn off for us when there is a cap table that really means that when you're having discussions with the founders and the team that you really want to bring in and partner with deeply, actually the people calling the shots are a bunch of investors that won't be around on day 2. And so I think you expect to see with late stage companies that there's plenty of investor support and plenty of cap table that bears investor names. However, I think those investors that are in a position to take too big a proportion or have too defensive terms, they do themselves no favors nor the company they're investing in, because it makes it harder not only to raise follow-on rounds from people like Eitan or anybody else, but also to find exits at the end of the day. And I've been through a few processes that have ended up in what you call a recap, where a lot of the investors have to agree to take a haircut on the stakes that they have in different proportions, and it's messy, just to make it so that the company can be funded once again or acquired or interesting to anybody else. So it's in your interest, but also in your investors' interest, to be sensible about how far you reach.
All right. Thank you, John. So there's another question from the crowd about your preferences. So at the pitching stage, do you prefer to see any potential income predictions, or do you care more about correctly calculated costs?
At the early stage, I assume?
Go ahead. Yeah.
Let's start maybe with John, please.
Okay. Shall I see this as an early stage pitch in this case? I suppose so.
Yeah.
So at the early stage, I care much more about predicting your costs accurately and recognizing the potential opportunity. I'm not very interested in seeing how much revenue you think you'll be doing in 3 years' time, because if you could calculate that actively, you wouldn't need investors. You wouldn't even need a job. So the reality is that knowing what you're going to need for the next 18 months helps me understand where the bottom floor is, and then help me to understand where the ceiling is in terms of potential. But don't necessarily spoon feed me that number. I don't think you'll ever be able to do that credibly. Eitan, you want to add to that?
No, I think you covered everything. Totally agree.
Easy.
All right, thanks.
Thank you. And building on that, we're talking about, for example, marketing as part of the whole budget. We see a lot of companies looking not only for just early stage, but for just growth money. It's sometimes looking for investors, sometimes looking for someone who would take just part of the responsibility and part of the cost related to the project. Who do you think could be good to contact? What type of investors do you think should be most interested in such pitches?
Yeah, so I think if you're already generating nice amount of revenue and your paybacks, your ROI is in place on your category, there are a lot of alternatives today to fund UA. First of all, investors. We do a lot of investments that fund UA, A rounds, B rounds, etc. There are a lot of debt resources for funding UA. So I think if a company is at a scale where your numbers are already in place, again, you're at the scale in terms of revenue and you're okay in terms of payback, then there are a lot of debt alternatives. There are a lot of investors. And you should be okay with raising capital, because that means that your game is in the right place, and just making sure you're approaching the right investors or the right banks. If you can drop me a line and I'll introduce you to 10 of them. There are many opportunities, but again, it really has to show that not only, if you're making endless amount of revenue, but your payback is 2 years on a mobile casual game, you're not in a good place, right? You should be returning at least your payback on a very shorter period. So it's really benchmarking and making sure that you're aligning with the KPIs.
Jonathan, would you like to add something?
Sure, I fully agree with that. I think that's exactly right. I think there's two camps of people who go out and look to raise money for user acquisition. There is the camp of people that only need the cash, and they have the ability and the technical capability to deploy that cash on effective user acquisition. And then there's the much more common second camp, which do still need the cash, but also probably need some help in doing it at scale, right? That one of the biggest competitive paradigms right now in games is the ability to spend on user acquisition better than the guy next to you. And so I think that's where you start to see investors and publishers shine. I'm biased, of course, at the moment. I think publishers are a great option for specific products that need to be scaled. But obviously, you need to find the publisher that can do that well and not just talk the talk. And then if you're in the first camp where all you need is cash, then I think really debt is a pretty great solution. And like Eitan said, there's quite a few providers now.
Okay, and I think, thank you. And I think we have the final question from the crowd. If there are more, please add to the slide now, because we are coming to an end of this session pretty soon. So the last question is a more generic one. And Sam is asking, how can small gaming startups compete with gaming giants with huge production and marketing budgets? Have you seen some good examples of those kind of battles?
Yeah, of course, you have one representative here on the panel. Huuuge were not the first with the social casino, and look where they are, right? Oh, of course, there are many. John, go ahead. You can tell the story of Huuuge.
I think that
covers it all.
It's much nicer when somebody else is saying that for me, then I'm less advertising. But no, it's true. I think if you look at the top 10 grossing games right now, very few of them, I can think of maybe one or two, had the privilege of coming into a totally open market. Like everybody breaks through. This is the beauty of games, right? Every now and again, you get a Flappy Bird that nobody sees coming out of the mist and you punched in the throat by it. I think that's beautiful and fantastic. How do you compete with them today? Two answers. The first is I think you don't compete head to head. You do something that's a bit different and explain why there's a space in what you're doing. It's exactly what Eitan said earlier. Show me the stats behind why converging two genres makes a lot of sense. Because if you're going to go straight against the play rates of the world, that's a really steep hill to climb. I think the second is if you can't beat them, join them, right? And I'll take this opportunity to advertise a little bit. Partner with a company either through corporate venture capital or through publishing or a direct acquisition if you're at that stage, and really leverage what they have. There's no loss in pride by joining a winning team, whether it's Huuuge or anybody else.
Yeah, I couldn't agree more. I think don't worry about the big growth through acquiring the smaller. Just find the differentiator, and then it doesn't matter if you're competing with a big or a small. Just find why you're unique. Remember that games are like they're a TV series, right? Just want to make sure that people want to see the next episode, the next episode, the next episode, and that's how it works, right? You should just be looking for the differentiators. I think that's where the uniqueness comes. And look at all the games that in the top grossing today, top grossing 6 months ago, they were all unique in something. So, and that's the hard part. But when you get it, you can really nail it. You see companies that didn't exist 3 years ago are doing $1 billion in revenue a year now in gaming. It's incredible, right? So it's a fascinating space to be in. We're all very privileged to be in this space.
Exactly. Gentlemen, thank you for your answers.
Thank you very much for the whole session. Please, of course, guys who you are online, reach out to Jonathan or Eitan for any follow-up questions. Thank you very much for the attention and for your time. Please remember that we'll have, of course, some other webinars in the future. Like one of them is coming just on the next Tuesday. It's focused on creatives, and I think like that topic not only important just for like mature companies that are like on the growth stage, but that's pretty good topic for even gaming startups on one side to grow their games, on the other hand maybe just validate some business ideas via creatives, and then check based on that if the business idea you have is really good and can be really interesting for the investor as well. Then please please give us the feedback. At the registration emails, you will receive the follow-up asking for the feedback. Please fill out this. It is very, very, very valuable for us, because that gives us idea how such content is really interesting for you, to which extent we should continue that, and what can actually we can improve them to make it even better. So with that, thank you very much for your time. I hope it was useful. See you on the next one. Thank you.